if it starts to become significant in that market, people are looking for yield. They'll reallocate from something else that's not very interested in the treasuries or fixed income or something, right?
Yeah.
So I think that makes it more scalable, but it could cause it to be a bit harder to go big. But there is some advantage to being big, which is they get into stock indexes that benefit from passive flows of people making regular savings that get dropped into like an index fund.
Right.
So I think Saylor is, with MicroStrategy, they're in one of those index, but there's another target coming up, which, they need a certain number of quarters of profitability and size, and they're getting there. So they may get into it soon.
Adaback begins by highlighting an eye-opening figure, a $200 trillion arbitrage opportunity. This staggering number represents the global pool of assets, sovereign debt, corporate bonds, and dormant cash reserves that are being silently destroyed by inflation and financial repression. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. He argues that Bitcoin is the escape valve, a lifeboat for capital trapped in value-destructive environments, and corporations that move early have a serious first-mover advantage. That calls it corporate capital arbitrage, but this isn't some secretive short-term trade. It's a strategic shift in treasury management, replacing fiat reserve with Bitcoin. And unlike most arbitrage plays that stay hidden, this one is taught openly, most notably by Michael Saylor through conferences, playbooks, and public case studies. So the message is clear. This isn't fringe anymore, it's a blueprint. And the smartest capital is already listening. Now, let's go back to the video.
If you take the 200 trillion, that is the size of the arbitrage, and then that's an enormous amount of money. So you can look at the treasury companies as one of the vehicles to arbitrage that future, because they've got, while Bitcoin's going up, they can bring forward corporate capital mechanisms and buy that at a discount. And their actions are also applying pressure to Bitcoin, probably bring that period forward. So it'll kind of accelerate, hyper Bitcoinization, basically. So from that point of view, I think it's very scalable. And you can see that Saylor, was very relaxed about getting other people. He has an annual conference where he tries to encourage people and provide the playbook and explain the accounting rules he used. It's got a bit simpler now with the spot ETFs for companies to use those even. But, clearly he's not feeling it's competitive in terms of, for people who are doing an arbitrage, sometimes they're trying to keep it quiet because they know that it's not very scalable, and if other people pile in, it'll disappear. But here it's an enormous dislocation. So it's like the arbitrage of the century, basically. I mean, I think there is an effect, which is that strategy is a bit indexed to the MNAV you can hold. So if you have a higher MNAV, if the MNAV is 3 rather than 2, when you sell shares or sell convertible notes, it makes it more accretive in Bitcoin per share per dollar in. And that's partly where MetaPlanet and OldBG have an advantage, which they have a high MNAV. And so when they do a corporate action, whichever version, it's more effective. So it's a little weird because kind of sort of self-reinforcing. It has a high MNAV. The high MNAV helps it keep a high MNAV because the corporate actions. So that factor is one thing that makes people skeptical, but they do need a fundamental to get it to the high MNAVs and earn it, like justify it. And keep it, because they'll drop and then they'll come back. So there is something fundamental there. So, but anyway, I think it's enormous, and so that's the scalability question. And the other one is sort of sustainable. Can these companies maintain their yield? Can they keep doing it, or is that just going to droop? And one theory for why it might fall is as they get bigger. If you take something very small, they can create a 50% return. Start with 1 Bitcoin, you can buy half a Bitcoin, and now they have 50% return in one shot, right?
Easy.
So that's true, but once it gets going and it's 100 million versus getting over 100 billion in Saylor's case, they have. I think their ability to raise is somewhat scalable with their size, right? Because, sort of the debt ratio, right? If they're both targeting a 1.3 debt ratio, the 100 million guys, they can raise 30 million, and the 100 billion can raise 30 billion. And Saylor is doing it. He is bringing in larger amounts of money in bigger chunks.
Yeah.
And, I guess the other question is, like, do they start to exhaust the arbitrage players and the bond market, the competition, right? But those markets are very big.
Yeah.
And the convertibles are extremely attractive for those traders. They're the best, the best upside, the best volatility product on the market for their strategy. So I think ultimately, if it starts to become significant in that market, people are looking for yield, they'll reallocate from something else that's not very interested in the treasuries or fixed income or something, right?
Yeah.
So I think that makes it more scalable, but it could cause it to be a bit harder to go big. But there is some advantage being big, which is they get into stock indexes that benefit from passive flows of people making regular savings that get dropped into like an index fund.
Right.
So I think Saylor is, with MicroStrategy, they're in one of those index, but there's another target coming up, which, they need a certain number of quarters of profitability and size, and they get in there. So they may get into it soon.
Zooming out, back paints a sobering macroeconomic picture. Most major economies are trapped in an era of financial repression, where inflation quietly eats away at cash while interest rates stay artificially low. Holding fire reserves in this environment is a guaranteed long-term loss. Corporations with massive cash stockpiles are slowly waking up. There's now a fiduciary obligation to consider alternatives, and for tech-forward companies, that alternative is Bitcoin. Back argues it's only a matter of time before younger, innovation-driven leadership teams at companies like Microsoft or Apple are forced to seriously consider Bitcoin as a treasury asset. And while shareholder proposals for BTC adoption haven't yet passed, the fact that they're being filed at all signals something major. Bitcoin isn't just on the radar anymore, it's on the agenda.
Effectively, it depends which approach they're using. So you can see MicroStrategy, they're quite transparent that they're learning. So they start with one strategy. So when they started, they used their treasury. Firstly, they did a share buyback offer so that people didn't believe in it could leave. So they bought them back at premium. Most people stayed. They bought their first slug of Bitcoin with cash, and then they ran out of cash.
Yeah.
Plus or minus, right? And so the next thing they did is took a corporate bond. It's a long-running company with steady revenue. So they had a credit rating to bring in a big corporate bond. They built up a debt ratio. And so they were quite aggressive into their first bear market. So the price fell, they did more, right? And they actually they overcooked it. So, I went back and looked at it. I bought some of it in that bear market period, but I went back and looked at it in terms of how much debt they had versus the net asset value of the Bitcoin. And the debt got larger than Bitcoin for 5 months in a row. So if that was a leveraged position on exchange, they would have been liquidated.
Right.
So now it wasn't, directly margin callable. They had the equity cushion, had plenty of revenue to pay the interest on it. So they just, plowed through it. They did something tactically interesting, which is they had at the tail end of it, like a 200 million collateralized Bitcoin loan from Silvergate.
Okay.
And Silvergate started to suffer in the market and they needed liquidity fast. So they actually bought back their own debt at like a 30% discount of Silvergate.
Yeah.
So that worked out well.
Yeah.
But generally speaking, I think you can see that they've learned from it, right? Because now they are targeting the conservative leverage ratio. And they also cleaned up the callability, so there's no direct lien on the Bitcoin.
Right.
It's restructured things and they had, the negotiating power to do that. So it's in a safer position
But they're able to do that because of who they are. But what about all the new entrants that are?
Well, that's a very good question. So, there is a potential risk that some new entrants push it too far in like an attempt to catch up or, getting a bit too exuberant and pile on straight debt that then they have difficulty servicing in a bear market, They get too high leverage. Now, some of them, like two of the ones that have a very high NAV actually have almost no debt, interestingly. So MetaPlanet has almost no debt, and OPG has debt, but it's Bitcoin basis debt. So the debt, if Bitcoin price falls, the debt shrinks. And so they never get into a kind of solvency issue with ability to repay, right? So, but yeah, you might see that in a bear market, that some people have made some kind of over exuberant straight debt structures that could, So I think one of the risk points is people are looking at the big ones and saying, well, if MicroStrategy sold like 500,000 Bitcoin in the market, well, create a debt. I don't think that's happening because the debt ratio is low, and they got a lot of levers to play with, and a lot of the debt they have is convertible,
right?
And so they can, they're converting it as it reaches premium. So the debt that's left over when the market turns, which presumably will eventually, is it's manageable. And I think the other thing is, the average entry price into Bitcoin is like 65, some probably is gradually creeping up to 70. So they got some headroom from the 110 level,
right?
And the floor price, this 200-week moving average, is also creeping up, right? 47. Soon enough it'll be 50. So, and if that's an indication of, well, the market probably won't fall below that kind of region,
right?
There's a safety in that. But past history doesn't necessarily predict the future, also, right? So, and if the phenomenon gets big, it could contribute to the market dynamics in a negative way, I guess.
Yeah.
So, you just hope that the people that take the risk that goes wrong do it when they're small, so they don't have an impact on the market. Right. Or the other thing that occurs to me is that, a bigger strategy company could buy them, Well, I think, because what I was saying about the scalability of the approach, I think eventually it will pull in some of the larger cap companies because, there is literally a fiduciary obligation to protect their shareholders' interests. And some of these companies are sitting on like $1 billion plus of cash, or probably more, right? 10 billion or something.
Apple, billions.
Yeah, right. And so, realistically, with the M2 monetary expansion and the debt ratio in the major economies, we're probably facing, a decade or two of financial repression, which means that the inflation rate is higher than the interest rate.
Right.
And so if they have 10 billion or more sitting in US treasuries, they're just straight up losing it.
Right.
And so that's not, Warren Buffett would say cash is king, and he's waiting for an opportunity in the market, and he's good at like waiting for the bottom of the market to go buy stuff.
Yeah.
But in the meantime, like, why is he losing money on the cash? Right? There's an obvious alternative. So I think, some of the sort of more technology focused companies with younger management will probably start to get there. You've seen a couple of shareholder requested votes for the boards with Microsoft and Apple, it didn't get passed, but the question is coming in. And there are Bitcoiners in there. I know some ex-Microsoft people on the top management or on the board who are Bitcoiners, right? And so there are people around them that understand Bitcoin, have been at Bitcoin for a while, who would, try to explain it to them.
Yeah.
Adam Back's insights offer more than just ideology. They're a masterclass in Bitcoin-based capital strategy. He's not pitching Bitcoin as a speculative bet. He's pointing to a massive, overlooked arbitrage opportunity sitting at the crossroads of corporate finance, broken monetary policy, and systemic macro distortion. This isn't retail hype. This isn't a passing trend. It's a decade-long structural rotation that could become the most significant capital shift of the 21st century. If corporate treasuries continue allocating responsibly, Bitcoin adoption won't be driven by ETFs or consumer apps alone. It'll come from a strategic redeployment of trillions in idle corporate capital. So the next time someone tells you Bitcoin is just for retail gamblers, send them this video. Because what Adam Back is describing isn't just the future of corporate finance, it's the blueprint for a new global monetary era.